consideration that if you are selling now for 100, and in 2 months you are going to sell for 90, you cannot recognize the 100 now, because it wouldn't be a true and fair picture. You understand what I'm trying to say over here? Because that is something that I actually didn't understand for a moment. Now I do understand it. That's a good news. Now, so what we are going to do, the transaction price is going to be allocated to the performance obligation, including the option based on the relative standalone price. Okay, remember this? Remember this. Relative standalone price. This is what we are going to use. So we are going to go to each batch and see how much is the relative standalone price. Okay, but now your question is, okay, I understand this, but how? Don't worry, case study comes. Now, estimate of the standalone selling price option usually reflect the discount the customer receives when exercising the option, adjusted for the discount the customer receives without exercising the option, and the likelihood that the option will be exercised. Whew, that's a long sentence. No worries, it's a lot easier than it looks. It's a lot easier than it looks. So what I need to take into consideration, how much is the discount? Hold on for a second. I grant you a right that if you buy 100 on full price, you can buy the next 100 at the discounted price 80%. Okay? But are you going to buy the next 100? I don't know. So I need to deal with it right now over here. Oops, sorry. Now, let's see what are we going to do. As an alternative to estimating the standalone selling price of the option, an entity could evaluate the transaction assuming the option will be exercised. So if you cannot decide what is going to happen, so if you cannot estimate the standalone selling price, there is a so-called look-through exception. This look-through exception means that if you don't know if it's going to be exercised, or you are unable to see how much is the standalone selling price of the future product, you're just simply going to assume that everything is going to be exercised, and you are going to calculate it according to that. Okay. Here is the case study I am trying to refer to. Look. Entity sells home warranty service for $750 full price in year 1. With an option to renew at the discount in year 2 and 3 at $600 per year, both conditions under the alternative approach are met. Now, what is the alternative approach? This one, the look-through. Then why am I solving immediately something what is the alternative one? Tell you why did I do that? Because honestly, you are not going to be able to tell the future, right? Or if you are able to tell the future, I have a suggestion for you. Go and play the lottery, and then you don't need to deal with accounting anymore. Right? So the alternative approach can be applied. What is that? So I just assume that the options are going to be exercised. So I look through the possibilities. And there are similar to the original goods and services in the contract. So similar things are sold. And they are provided in accordance with the original contract term. Look, these things are usually true. Because when you are selling an option for future purchases, when are you going to promise it? Not later, but when? In the beginning, right? You are going to promise it in the beginning. Now, this discount, what I told you before, is not available to other customers. Yeah, entity obtains 100 new subscribers under the promotion, and the entity estimates an annual retention rate of 50%. Okay. Now, actually, I took this example. I'm not telling you which type of computer, but it has an Apple sign. Okay, and they are actually promising these kind of things that if you are buying their extremely expensive laptops, you can buy an extremely expensive warranty for it because they are only guaranteeing that it's going to work for 3 months, at least in Europe. That's the minimum possible time, and then you can buy for around, I don't know, $700 a warranty for a year. But if you want to keep the warranty for the second and the third, you are paying, I don't know, like a discounted amount. Now let's see how are we going to account for that. Now here, what is the main product? What is the main product? No. In this example, the Apple example, I mean the Apple sign example, forget it, okay? This is the main product, the 750, okay? I already sold 100 out of it. How much revenue should be recognized? Well, some of you may say that, why don't we just recognize $75,000? It looks, hold on, that's a little bit much. So, yeah, $75,000. It looks logical, no? Because the next year, if they renew, you are going to grant exactly the same thing for how much? 600. And in year 3, you are going to do exactly the same. Now, this is where revenue recognition would be false, right? Because you are doing exactly the same service for a different price. This is called the option for future products. Therefore, you need to make an estimation, and this is how you make the estimation. Now, the total estimated warranties that you are going to sell is 175. How do I know that? How much did I buy in year 1? I sell in year 1. 100, but it's the retention rate. 50%, so therefore in year 2, 50 will subscribe, and in year 3, half of it, 25, will subscribe. So altogether, I sell 175 guarantees. Now the total consideration, what I will receive is, look, the first 100 is going to be at 750, the second 50 is going to be at 600, and the third 25 is going to be 600. If I did my mathematics right, it's $120,000. Okay? But this $120,000 is 175 pieces. So the allocated price per unit is this much, right? Which is the 120,000 divided by 175. So what is going to be my accounting entry? Did you get this so far? It's pretty easy, right? What did I do? Without actually noticing, I looked through the option. What do I mean by looking through the option? I don't care if it meets or not like this. I assume that it's going to happen, right? Okay? This is going to be the accounting entry. You debit your cash, $75,000. And what are you going to do with it? Only record the revenue up till the 68,000 whatever, okay? And the rest is going to be a liability. The rest is going to be a liability because of future revenues, okay? What did I need to use this method? The goods that I'm providing are similar. Hold on, they are not similar. They are exactly the same, right? And the pattern of transfer, right, is the same. And also, I already granted it when? Basically at the contract, at the first minute, okay? This option. Now, identifying the performance obligation, well, we already know when is it distinct. Tell me when is it distinct in most of the cases? When we are selling it separately, and from the point of view of the contract, it's also separate. Remember that it's a two-step model. It's not only the legal aspect, but also not only the capable of being distinct, but also it's actually distinct. Hold on for a second. Is this warranty really distinct? Yeah. How do you know? Because I can decide if I buy or not, right? And is it providing service to the customer separately? Yes. Okay? Now, and also, next to this, there are some other guidance, what they put in to this, this stuff in the standard. Well, it is going to be the right of return, how to deal with that, because that's something what is very common. The product warranties, which we already looked at, but there is another consideration. The licenses and rights to use, options to acquire additional goods and services, like discount vouchers, customer loyalty points, and principal agent considerations. Now, honestly, the principal agent considerations, we are going to discuss only at the end. Just very quickly, what do we mean by principal agent configuration or variation? What is that? If I'm only an agent, if I am legally buying the goods, but I'm only actually buying it if I sold to third party. How do we call that? Consignment inventory. Now what do you do with consignment inventory? You only recognize it when the seconds is done, and actually you recognize it and immediately de-recognize it because you sold it at the same time. So this one needs a little explanation. You had a question?
Yeah, the previous one, I'm just trying to think about the, in year 2 and year 3, when your percentages which you anticipated was wrong.
When the percentage that we anticipated is wrong.
Yeah, then how do you true up?
A very, very good question. Every year you make the same estimation again. So what are you going to do with it? You are only going to adjust with the difference.
So you don't do a sort of restatement?
No, you don't restate unless it's a mistake. Right. What is telling you the restatement rule? Restatement rule is in where? IAS 8. And IAS 8 is telling you that you need to restate if and only if it is an error. Right? Because this is going to be what? A change in the estimate. Change in the estimate is, no matter how material, is not going to be treated as a restatement, but it's going to treat it as a, basically a prospective thing. Okay. Now, let's see how are we going to deal with these things that I already talked about. However, before going further, I put a little summary, what I think that the main changes are. The first thing that the new standard is telling you that performance obligations are promises, explicit or implicit, to the transfer of goods or service to the customer. So that's the first one, that these are promises. So it's not actually a standalone contract, only a promise within the contract. Identify that at the beginning of the contract, and it can be customary, so it doesn't have to be written, it can be implied or oral. Right? If distinct, both individually and in the context of the contract, promised goods or services are accounted for separately. Understood? Understood. So it's accounted for separately. So we don't account for the contract, but we account for what? For each performance obligation. This is what I told you. We want as little as possible, because if we have a lot, then we have a lot of job, right? Because we need to follow each and every one of them. Hold on, what does it need? What do you need to make in order to be able to fulfill this requirement? When you go home, not today, because tomorrow there is still a day when we are going to meet, and that's going to be consolidation, which is going to be mega fun. And I think that hedge accounting may go to tomorrow, so tomorrow it's going to be splendid. But when you go home tomorrow, you immediately open the server and you find all your contracts, what you make as a company, and you do what? You try to look for the performance obligation, and you try to see how miserable your life is going to be after 1st of January 2017. All right. Now, let's see what are the main changes that we need to take into consideration. And that's the most important part. Guys, current IFRS has limited requirements for transactions with multiple deliverables. Okay? Entities may identify different performance obligation, more or less performance obligation, compared to deliverables identified under current IFRS. So that's the main change. What's the main change? That in the current standard, they don't really deal with things that we have multiple deliverables. Okay, hold on for a second then. What did we do so far? We tried to use our brain, right? Did we end up exactly with the same things? Well, not exactly, but more or less we done the same. Hold on for a second. What was the rule that we were using when we have multiple deliverables? What is the rule that we were using? Who remembers? Anybody knows this? Anybody knows this? Emerging Issues Task Force 21. Well, that's actually a rule there in GAAP, US GAAP, right? When they actually made a short summary how to deal with these things. To be honest, this whole performance obligation thing is basically coming from
US GAAP?
Basically, it's coming from the US GAAP. In the US GAAP, they didn't have detailed solution. Who does US GAAP here? Anybody? Okay, then you guys need to be aware of the following. How do they record revenue in US GAAP? They have for every industry something specific, right? So actually, US GAAP became a big accounting cookbook, right? Which means that if you are in an industry, you just pull out a rule, right? And then you see how are you going to do it. Which means that knowing US GAAP is basically impossible, because then you have to know every industry, right? It's very funny. One of my students at the university that, she was a PhD student, and when she had her PhD defense, it was like, I read US GAAP. This is what she said, and I was like, good, right? Which means, read that much, right, from the ground, because US GAAP has a rule for everything, right? And this is where they got this whole thing from. Emerging Issues Task Force 21. You know what's the good part? It's only 5 pages, okay? It's easy to read, and it's easy to remember. And if you read it, it's not going to be identical with IFRS 15, but it will give you a very good idea what to do. So I highly recommend you to read it, okay? 5 pages, I promise, okay? And it has an example in it. It's a good one. It's a good one. Okay. And also, one of the biggest change is going to be that some warranties maybe need to recognize as different performance obligations. I will talk about this in a minute, because that's a really detailed rule. That's a really detailed rule. Now, let's see the following situation. Okay, and let's see what is going to be the solution. An entity enters into a contract to manufacture and install a customized equipment and to provide 5 years of maintenance service. Installation service include the integration of multiple pieces of equipment at the customer's facility in order for the equipment to operate as a single unit. They do not sell installation separately, but other vendors could. If they determine that the installation is highly interrelated to the equipment, as the equipment is significantly customized as a result of an installation, it may not be a separate performance obligation. So basically, what did I do? You remember that was the original example I just made. And using the rules that I actually explained you, now, actually this is the official solution. That the installation and the machine that we were talking about are not separate performance obligations. Now, let's see what is a single performance obligation. A series of distinct goods or services may need to be treated as a single performance obligation if they are substantially the same, have the same pattern of transfer, and meet specified criteria such that the performance obligation is transferred over time, okay? And the same measure of progress is used for each good or service. Typical example, daily cleaning service provided over a year. Okay? That one, how many performance obligations do I have? Well, if you like, I have 365. But are they actually different from each other? No. So how many performance obligations do I have? 1. Okay? That's actually a practical issue. The pattern is obviously the same. Now, right of return. That's something what the standard is actually dealing with separately. Let's see what is the rule. Revenue recognition would be limited to those goods not expected to be returned. Okay, what does this mean? That at the beginning of the contract, I need to assess how much is going to be returned. Which means that what I need to do, I need to make a refund liability for the expected refunds, and actually I have to assume it somehow. And the corresponding asset and adjustment to cost of sale would be recorded for items expected to be returned based on the expected value less cost to recover. Okay, hold on for a second. What is that? If you know that some of the goods are going to be returned to you, then what you are going to do is, instead of recognizing it as a revenue, you are going to credit liability and debit, well, your revenue, right? Because when you receive the cash, most probably you put it to the revenue, and then you will estimate how much is going to be sent back. Now the standard became obvious because sometimes previously what we done, we only took the margin out of the revenue. Why did we do that? Only the margin. Why? Because actually if they return, the profit that I will suffer, the profit loss that I will suffer is only going to be the margin. Why? Because they return the goods. So in my hand there are going to be still goods which I can use, resell, right? So the standard now became obvious. And instead of guessing, now they are telling us that you need to remove all the revenue that was related to that specific return, but at the same time you need to show a so-called return asset. What is that? That is the value of the asset which is going to be sent back to you. So you will debit, not inventory, because that's not inventory yet. But this is what? A return asset and credit cost of sales. So basically you will reverse your sale. There is only going to be one exception. What is going to be the exception? That actually it's not going to be put to inventory, but it's going to be put to a special line. All right? Now, and the return asset is subject to impairment testing, which means that you need to see if you are really going to be able to sell it. Okay? Because if it is sold because of defectiveness, obviously that asset will not be able to sold. Okay. Now, a right of return may be contractual, an implicit right that exists due to the entity's business practice, or maybe the combination of both. An entity may have a stated return period, but accept return over a longer period. What does this mean? If this is happening, then I have to take which period? The longer one, all right? Because then I have a contractual one, then I have an implied one, and I have to take which one? The bigger one. The customer exercising its right to return may receive a full or partial refund, a credit that can be applied to amounts it owes to the vendor, a credit that can be applied to the purchase of other goods or services, or a different product in exchange. Offering the right of return means a company stands ready to accept a returned product, but this is not a separate performance obligation. Okay, so that's the important part. So that's not going to be a separate PO. All right, why? Isn't it a separate performance obligation? It is, but the standard excludes it. But the standard excludes it, and we'll have a special treatment on it. Now, so what is that we are going to do? A revenue should not be recognized for sales that are expected to fail because the customer exercises the right. This is what I already told you. No revenue. And entity needs to estimate their expected returns and recognize the revenue net of expected returns. The amount entitled are reasonably assured to be entitled at the end of the return period, and exchanges of products are not considered to be returned. So if you just simply exchange, that is not going to be an accounting entry because actually that's only a replacement. All right? Now, the return asset may have to be shown separately from inventory. That's important. So the return asset is not inventory. So separately from inventory, it's not inventory. And also, you need to understand that since these returned assets cannot be sold at a full price, most probably what are you going to do? Most probably, you need to estimate how much is going to be the cost, what you still need to incur in order to be able to recover the goods, right? For instance, you need to take it back, you need to repair it, you need to repack it. So therefore, there is going to be an allowance for it. It's not going to be an expense, but the return assets value is going to go down, right? So the return assets value is going to go down. A return asset is recognized against cost of sales. All right, here is a small example.
Lastly, just 1 second. So what you're saying is IAS 2 will not apply to return assets.
What do you say?
IAS 2 inventories does not apply to
it does not. It is saying that it is going to be a return asset according to IFRS 15. And the rule is the following. Take how much can you sell it for? minus what you still need to spend in order to be able to sell it, and that's the value of your return asset. Hold on for a second. What is IAS 2 saying about inventory? Cost or net realizable value, right? So is it the same? Yeah, it's going to be at the end of the same. It not applies, but it's still going to be something what is end up at IAS 2. So at the end of the day, you are going to end up there under IAS 2, although it's not under IAS 2.
You need probably a separate accounting policy for it.
You need, yeah, of course, you need to put an accounting policy for that. I agree. You need an accounting policy for that. Here is an example, okay? Using an expected value approach, ABC estimates that there is a 20% probability that no products will be returned. 20% probability that 1% of its products will be returned, and 50% probability that 2% of its product will be returned, and a 10% probability that 3% of its products will be returned. ABC estimate is 1.5 calculated as follows. See, so they take the weighted average. Now, question, in accounting, and this one will require the knowledge on IAS 37. When are you allowed in accounting to use weighted average?
Inventory weighted average.
No. When are you allowed to use weighted average weighted by probability? Guys, that's an important issue. It's IAS 37.
When is profit? Yeah,
Provision, but okay, hold on for a second. Then I'm asking something totally different from this, and you will understand why I do that. I have a low case, and there is a 40% probability. That's one single case. 40% probability that I need to pay 1 million. There is a 30% probability that I need to pay $500,000. There is a 20% probability that I don't have to pay anything. And there is a 10% probability that I have to pay 5 million. That's a low case. One single low case. Which one are you going to take as the best estimate?
Weighted average.
No. Forget it immediately. If it's one single case, you are going to take the most likely outcome.
Most likely.
Which is going to be?
1 million.
1 million. When are you allowed to do the weighted average? If you have lots of transactions, lots of cases. In this case, do you have lots of cases? Yes. Therefore, weighted average is an appropriate way to measure it. Okay? But weighted average requires a lot of cases. Sometimes this seems illogical. However, that's the rule. Okay? I'm not saying that's the most logical rule ever, but that's the rule. You can only take the weighted average if you are having a lot of transactions at the same time. Now, so in this case we had a lot of transactions, so we are taking the 1.5, right, as a return. Now, accordingly, ABC recognizes revenue only for 98.5% of the products that it expects will not be returned, resulting in a revenue recognition of this much, right? Look, 1,000 units times 200. Well, this was the data outside, and I'm only taking this many out of the revenue, 197,000. Okay. So, which means that I will have a refund liability of 3,000. The asset to be returned is measured at. How much was the selling price of each? 100. So I will get back 1.5. So this is the cost. Do I need to do something with this 1.5 thousand? Yeah, one more thing. What? I need to see if I will incur additional costs to repair. You know, there are a lot of things that may happen to them. Usually you need to repack it. That's for sure. So it's very rare that you can just simply take it as is. What do you need to deduct? There is one thing, however, what you need to remember. Can you use the selling price here as the returned asset? No. At least you must take away from your profit the margin. What we are doing currently. They are saying that maybe the margin is not enough to take away. Why? Because you will have additional costs that you need to incur. Okay? So, the accounting entry is going to be this. Debit cash, 200,000. Credit sales, only the 197. And you credit a refund liability. So that's going to be on your balance sheet, basically as an unearned income. As an unearned income. Now what are you going to do with the same? You debit cost of sales, but look, not the 100,000. Or well,